Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Paris Rapeseed, Winnipeg Canola and Malaysian palm oil markets.
I have said this now for over 2 months. It was and still is sometimes a sheer joy to write commentaries because of the beauty of the patterns that show themselves. Well, it continues to be so here. There are still 2 key patterns. The first and larger one is the February 2021 to July 2022 ascending broadening wedge pattern. This has disappeared up over the top left of my daily chart. To be honest, it is a large but imperfect pattern, yet it had been the main market driver higher in the early part of 2022. The break lower in July last year left the following incredible targets on the downside, which I highlighted at the time. The primary target X is in the 352 area, with a harder to reach secondary target X1 in the 217 even area. These were, at the time, pretty much way out there targets that you could put into your diary on the back page and just look at them maybe once or twice a year. However, there still is a newer, smaller pattern, though it deceivingly looks quite big on this daily chart. It is the early July to late October 2022 bearish Andrews pitchfork. And this is where the joy comes in. The market has since October last year moved down within this bearish pitchfork, mainly as it is now in between the middle time below, currently at 403 3/4, and the upper time above, currently at 474 even. You can clearly see the times highlighted in purple on my daily chart. I thought back when I drew this one that it might eventually need finessing or even turning into a shallower bearish shift pitchfork, both of which I would have been happy in a heartbeat to have done. But so far, and it's been quite a journey, it has not needed any surgery whatsoever or finessing, and is still excellent in showing the bearish angle of attack of this market. The only new feature has been the drop below the congestion between 438 to 446, resulting in last week's weekly key reversal down towards the middle time, and some old support from the 2 necklines very close together, generated from November 2019 to February 2020 move at 399 and 401. These are also close to December 2020 low at 396. These would be the next area of support below the middle time. Winnipeg Canola. Back in late summer last year, I said at the time the following, and I quote, "It became evident since the start of the sideways to slightly lower movement we've seen here since June that there was a shallow bear channel," and that's for your information, currently between 863.70 and 751 even. To continue quote, "And it is this that has been driving the market lower during the summer." End of quote. To emphasize this point, I further added, and I quote, "So it seems that until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle attack of this market." End of quote. Well, as you can see, the bear channel was still there, leading the way lower until mid-March. To help you view it, I'd highlighted it in dark blue on my daily chart. Now, before I expand on the break lower, let me take you back to the start of this year and another feature that has impinged upon the market. It was the June 2020 to date broken uptrend, which I've still kept highlighted on my daily chart in bright red, currently at 857.5. I've deliberately said to date, though that's perhaps implying it is still influencing the market, despite it being clearly broken. The reason why will soon become evident. Okay, so the market sorted down through this uptrend in early March, and for a while it looked like it might see the bear channel morph into a sideways triangle made up from the upper bear channel line and the red broken uptrend. I personally have also embraced this idea of a sideways triangle. Indeed, I saw them and still see them both working together with the subsequent break lower, with all the implications that has. Thus, for the sideways triangle, we had a primary target in the 768.5 area and a secondary harder to reach target down at X1 in the 688 even area. 10 weeks ago, the market dropped down and reached the primary target, though the market took its own sweet time in finally reaching down to target X1 at 688 this past Monday. This move lower also meant that I had placed under closer scrutiny some of the potential targets below for the bear channel pattern. Thus, the primary target for the move lower and out of the bear channel had already been reached in the 726 zone. And we still have a secondary harder to reach target X2, which is still live lower down near the bottom of my daily chart in this 644.5 zone. Now, one final point, and it's something I've raised now some 19 weeks ago and on every occasion since, and I quote, "There is just the thought of what may be the whole April to date action," so that's April 2021 to date. "It can be seen as part of a very large bearish halfway hesitation. It is all still too early on these thoughts, but I think they need to be present when the things start to happen, eventually." End of quote. We are again further along, and thus closer than ever now, to looking at this action as a possible very large bearish halfway hesitation. We are close enough that I dare suggest a possible target for such a pattern below in the 560 even zone. This is another one that you put in the back of your diary and look at every so often, just in case. Bursa Malaysia, crude palm oil. Back over September and mid-October last year, the market formed a small but effective reverse head and shoulders pattern. It was the break higher over the neckline for this pattern combined with the break higher over the old neckline of the September 2015 to November 2017 head and shoulders top. That's currently at 39.93, and finally the break above the short medium moving average, currently 38.97, altogether caused the move up in early November and the construction of the next mildly bearish pattern. For a while, any attempt higher saw a subsequent drop back to the seeming security of the combination of the old neckline, short medium moving average, and the medium moving average, currently at 39.34. However, when I took a step back for a moment, we still have live the mid-August to early November 2022 mildly bearish shift picture, which is highlighted in green on my daily chart and constructed from that earlier reverse head and shoulders pattern. This mildly bearish pitchfork has guided prices more or less lower in between the upper tine above, currently at 42.06, and the middle tine, currently at 35.68. 2 weeks ago, prices tried to punching down through the middle tine, but as in March and early December last year, prices failed to do so. What was interesting this time was that prices reverted back up, gapping higher, but a lower high than in April and in March, and created an island top centered around last week's action. The fall this week has been the most concerted attempt to move below the middle tine, and we have indeed had multiple consecutive closes below the middle tine. But the move lower has yet to be properly exploited. And going back to the island top for the moment, the primary target for the pattern was in the 35.25 zone, a level that has already been achieved. But a secondary, harder to reach target X is still live in the 34.10 zone. It will be interesting to see if this level, so close, can be reached. Finally, we may possibly have a dead cross of the declining medium moving average, currently 39.34, moving below the long moving average, currently 39.33. The problem is that the long moving average is flatlining at the moment, hence why the dead cross has a lot of question marks all over it.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.